All right. Good afternoon, everyone. Welcome to the first 2022 edition of The Last Week in Mortgage Today. We're about 13 months into doing this show, committed to continuing to do it going forward. As always, same place, same time every week, every Tuesday, 2 p.m. Eastern. And each week, one of my favorite parts of this show is filling out the lineup of brilliant lender member co-hosts that we line up to help bring the show to all of you that are watching live and listen on podcast. This week, back in the co-host chair, TMC board member and chief lending officer for Lake Michigan Credit Union, Eric Burgoon. Eric, great to see you, bud.
You too, Rich.
Happy New Year,
everybody.
Happy New Year, and always like to have our co-host level set a little bit for the audience. Eric, if you could just tell us a little bit about Lake Michigan Credit Union's mortgage banking operation and anything else of note as we head into the new year here.
Yeah, well, we're a 100% retail shop. We operate all throughout the state of Michigan, and we're in Southwest Florida, and just recently bought a second little bank in Tampa. So we're kind of moving up the north coast of the Gulf there. So, but we got about 120 retail originators. Did 5.6 billion last year, which was 100 million down from the previous year, but pretty much the same kind of numbers. But one thing we do is we do a lot of construction lending. That was a big chunk of our business historically, and it was again last year too. So happy to be here. Happy to be part of TMC.
Awesome. And yeah, congrats on another great year for the credit union and one of the bigger mortgage originating credit unions in America, and one of the earliest members at TMC as well. So appreciate your early belief in what we're doing with TMC, and also taking on some additional responsibility, joining our board of directors a few months ago. So thanks again for that, Eric, and looking forward to having you as a part of that group.
Yeah, thank you. Yeah, we've gotten a lot out of TMC. It's really helped us, as I told you many times, Rich, helped us through the pandemic. All your calls and information and just getting everybody together to talk. It really works. We appreciate all you do.
Appreciate it. Well, let's get into it. And as always, any questions, comments, thoughts, anyone in our live audience has, please feel free to pump it into the chat or the Q&A, and we'll incorporate it into the show. Eric, heading into a new year, I always like to rewind as we go into a new year to look back a year ago and think how we were talking and what we were thinking and saying and prognosticating at that point. And last year, the year that just closed, a much busier year than anybody anticipated. We didn't know really what to think a year ago. It was still incredibly busy from the first major pandemic induced refi wave boom, and just ended up being, your numbers were right on. And that's pretty much what we're going to see for the industry. We'll get a little bit into the MBA's projections later in the show, but Lake Mich kind of right in line with the broader industry, just down a little bit from what was the biggest year ever 2 years ago.
Yep, exactly. Very, very much our second best ever, and very close to 2020.
And now we head into a new year, and just the straight math on how many people have refinanced these last 18 months into 30-year fixed rates in the mid to low twos. You can't ignore the math on it. It clearly will impact our industry going forward, and still some challenges to the purchase side of our business as well, most notably on the inventory side. And as we start to go through the news of the last week here, we'll start with pending home sales. Report came out late last week. November pending home sales fell 2.2% month over month, coming off the heels of an October pending home sales number that was up 7.5% from September, which caught economists and other prognosticators off guard. And if you look inside the numbers and some of the comments by National Association of Realtors economists, what they spoke to was October's numbers being higher than expected had a lot to do with sharp rise in rents in the fall, renters needing or wanting to get into contract on homes, and more of a regular correction into November. But as we head into the winter, the purchase side of the business is slowing down a little bit. Obviously, the refi side has been impacted, but is that what you're seeing in the marketplace as well, Eric?
Yeah, we absolutely are. Now it's by market, right? So we're seeing some of which we didn't really have last year, we're seeing the sort of some of the regular seasonal adjustments, right? I mean, there's snow on the ground here in Michigan, so that has, didn't do much last year to volume with all the refi activity, but from a purchase standpoint, it's certainly slowed a little bit. And I will say our Florida business is booming, but it's a bit counter-cyclical to the Midwest and the North in general. So that is going, very strong. But it's clearly purchase. We're kind of coasted into the end of the year. We did have a good December closing month, but we're really kind of cleaning up pipelines, and that's we actually closed more loans than we took in new applications for the first time in a couple of years at least.
Yeah, no doubt. And also inside the numbers, average time span of list date to contract date, 18 days still in November. So still no shortage of demand out there in the marketplace, just the supply side. And it'll be interesting to see what the new year brings for the inventory and the supply side of our business. Seems like demand continues to be strong to buy new houses. There's certainly some things that the new presidential administration and housing leaders are doing to help further bolster the demand side. But supply, the big unknown and the big issue, that is what controls what kind of year we'll see in the mortgage industry to a large degree, no?
Yeah, absolutely. Yeah. I mean, prices, going up too. So that at some point is going to choke off, a little bit of the market. We're seeing, on the very high end. So again, we do a lot of construction lending. So we're seeing, people that have money are building big houses, on the water or wherever. So that doesn't seem to have slowed very much. And the fight still continues for those entry level homes. That we're still seeing, most of our markets, multiple offers, not 10 or 12 or 15, but multiple offers, and that piece in the middle is a little bit, struggle a little bit. So slower there, but still a strong demand. And, we're trying to get the inventory back up to even back to the 2008 levels. You look at the number of homes that have been constructed, are still not anywhere near what was happening in the early 2000s.
Yeah, and I want to definitely get into the construction and new home construction side of the industry here momentarily. I know you guys are doing a lot of that business, and I really want to hear your perspective on that. Before going there, values in general, had another couple reports, news items this past week. The two major home price index reports that we get monthly, Case-Shiller and then the FHFA's home price index. Their year over year reports for October, Case-Shiller up 19.1% home values year over year. FHFA was 19.7. There was some trends in there from month to month that indicates that appreciation pace is slowing, thankfully. But as we just keep, I think we got into the spring and then the summer, and we kept hearing all the home price indexes were showing year over year gains of 15 and 16 and 17, 18, 19%. Seems like it's going to start to go the other way now. But while most of the projections for next year for the mortgage industry tend to be generally in line as it relates to 30-year fixed rate interest rates and total originations, the one thing that's still all over the board, and it's because of differing views on the supply and demand side and the inventory side of our business, is home price appreciation. We're seeing a lot of people come out now with projections 5-6% home price appreciation from now through the end of next year. Others have been out there very notably much more bullish, saying homes are going to continue to appreciate 13, 14, 15%. Really I don't see anything to slow down demand. I see a lot of things that can even further spur demand, all really just a byproduct of the inventory side of our business. And something a little worrisome to me was it was 2-3 months ago, we got all these reports, the Redfins and the Zillows. Oh, there's all these surveys and indications. We're going to have a lot of people listing their home this holiday season. We just didn't see it, at least not to the levels they were projecting. New stock aside, your just general thoughts on inventory, home values, and how that could play out in the year we now find ourselves in.
Yeah, well, actually, we moved during COVID. So, I mean, the one challenge, of course, is if you're going to sell your house, you got to find another one, right? So that it's sort of all tied together. So that I think it has a bit of effect, on what's at least in the resale market, the traditional purchase market, what's out there, what's available. So again, different price points have different activities that those again the low home price. Entry level stuff still super competitive, and those building big ones are a lot of demand for that, and it's just in that middle range that we're seeing. But I do think like interest rates at some point, right, have to affect this, right? I mean, rates, as you mentioned earlier, or rents rather, as you mentioned earlier, are going up, and so that drives people to buy versus rent or whatever. But it's becoming a challenge for sure, and as payment, you start looking at what the payment is going to cost on a home. That's going to eventually has to play into that. So that'll be a bit of a headwind, I think, into 2022 for sure.
Yeah, and then moving on to the ultimate and best solution to an inventory problem that seems like we've been talking about this for years now, and differing opinions on this. We've had Ivy Zellman on here that has a contrarian view on this, but most people say that we're short 5 to 6 million homes in America. And it is that shortage that has caused this perpetual inventory issue that shows no sign of improving. The solution there, of course, is new construction. And, there was just obviously have been so many impediments to the new construction market these last 15 to 18 months, mostly related to supply line issues, the very notable spikes in lumber prices we saw last spring, labor, skilled workers to build homes, land to build on. And a couple of reports came out also this past week from people very close to the issue, essentially just indicating that lumber prices very likely to remain volatile in 2022. We saw them spike to insane levels in the spring, then kind of fall way back down at the end of summer, and then kind of bump back up as we got into the fall months. Your thoughts on the broader construction market, being pretty close to it as a lender that does a fair amount of that lending?
Yeah, about 25% of our production is in construction, at least on a dollar volume standpoint. So that's a big part of our business. It's been a growing part of our business. We were up, just looked at 84%, our construction business 2021 over 2020. So it continues to, and that was up quite a bit from post or prior to pandemic too. So yeah, we do a lot of it. We see that as a growth opportunity still. You go back again to the 2008 timeframe. We all participate in all of our local HBAs, and we do a pretty good job of tracking permitting and such. And even last year, as crazy as it was, the permit numbers in some of our major metro markets, like Metro Detroit, they're a third of the peak permits pulled by builders in the 2005 to 2008 time frame. So there's still a lot of demand. There were not many homes at all constructed in the 2008 to 2010 or 12 range, right? So there's a definitely a lack of supply everywhere. And now people kind of want what they want. They've generally have money and want to build a house or move to another area and want what they want. So we're seeing a huge demand for construction. We have seen and have been watching kind of closely a lot of trying not to do build for investment properties, right? So there's a lot of people that kind of said, let's get into this business and build some homes and we'll put them on Airbnb or whatever. So we try to stay away from that a little bit more. That could sort of be a little bit of a parallel, we think, to some of the back in a time where high-rise condos and we got markets got overbuilt in some of the sand states specifically. So we're kind of watching that a little bit. We'll do a little bit of it, but trying to stay away from that. And really in construction, just maintaining the discipline. Make sure you know who you're dealing with, who the builder is, have a true relationship there, and work with the good ones. So it's an advantage as a depository. Obviously, we can put some of that business in our portfolio for a year when it's getting constructed. But it's a great business. It's and I don't think we've ever had a delinquency on a construction loan. We have things that happen during the process for sure that we got to work through, but it's a good business, and continue to be a big part of what we do, I think.
Very low delinquency rate, good cross-sell opportunity, right? To types of people typically that are building homes are either new families or step-up families, and a lot of opportunity for future business, either on the mortgage side or other credit union product side. And the issue though, just been pontificating about it on this show for really the entire 13, 14 months we've been doing it, is how do you talked about the pressure at the lower end, right? You want to buy in Ohio or Michigan a couple $100,000 home. There's not a lot of, even less inventory than the broader numbers, and more demand. And is there any way to effectively encourage or builders to build smaller homes? I know just from being in the depository and being in a lender that did a lot of construction business, you talk to the builders, there's just no money in building $250,000 homes. And how do we increase the affordable housing stock through new stock? It's a complex issue. There's no easy answer to this, but any thoughts on that?
Yeah, no, you're right. There's certainly no silver bullet on this one. We've seen a pickup, in especially some of our more rural area. Manufactured housing is an option that we've been looking to expand our presence there. So there's some agencies have gotten into that. So there's some opportunities at that little bit lower price, and in the multifamily condo market is a part of that too. But no real good answer for the lower priced homes. You just got to continue to to work with them. We do, renovations, another option, so we again, you got to kind of have a portfolio to do that kind of business. Then that, you do 203K or whatever too, though. So that helps, right? You can buy a lower priced home if you're willing to put the time into it and spend some money doing a renovation, maybe another potential, tool to get some business that way.
Yeah, very good point. This is the last week of Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative. This week joined by Lake Michigan Credit Union Chief Lending Officer Eric Burgoon. And Eric, as we look into the year that we're now getting into here, you look at the projections. MBA came out with their official projections for 2022, projecting total originations of a little over 2.6 trillion, about 34% drop from the year that we're just coming out of. And most of the other prognostications are largely in line with that, projecting around 2.5 trillion for the 3 years after that. So a much more normal volume climate in the years to come. Yet, lenders had to, by necessity, starting 14, 15 months ago, staff up to meet the demand of all these refinances. And just talking to leaders on this show, different strategies that those have employed. We've seen headlines from some of the large lenders in America that have done big layoffs, and we've seen more our members doing more strategic, right? Trying not to add people throughout 2021, and just the natural organic attrition of employees, trying not to replace. And how do you guys look at, you're coming off 2 years that are pretty similar, like a lot of the industry, and going to new year, we're expecting less volume. How do you look at just that side of it? Is it grow into it? Is it just, how do you look at, just staffing levels versus a year and some years to follow that are likely to be not as busy?
Yeah, so we tried to get a little bit ahead of it. So we, in 2020 and certainly last year, we did a decent amount of outsourcing. So, either actually, true outsourcing, outside the U.S. even, with some of our back office positions. And then what we did throughout the pandemic is just sort of promote, those that were in more entry level, data entry, setup kinds of roles, closing coordinating functions, move them into processing roles as we did, and backfilled that with outsourced. So we've started obviously ramping that back down as our volume declines. We've been able to do that for sort of the first level. And then, and technology has played a part into it. We happen to be rolling out a new LOS, and that's gonna change a lot of how we do things. But it does also, we want to keep, be a little bit overstaffed as we do that. So we make sure that that goes smoothly. As people come up to speed, we're going to be less productive. So we intentionally have carried a little bit higher level of staffing than what we would normally. But again, as a credit union, we tend to be, we didn't pay high rates. And we saw, we had calls on this, right? Where, an underwriter was going to get $200,000 or, $500 a file or whatever. We didn't participate in much of that. And most of our people were loyal, stayed with us. And so we'll do the same. We'll stay with them on the downturn. We've never done a layoff at Lake Michigan and don't intend to. So, but we got to be smart about that and tried to get ahead of it, again, through outsourcing and some technology and some other things, like that, just shifting people around. And it's amazing as you get to be the size, that many of us are, that we are. We have, almost 500 people in the mortgage business here. So a little bit of, hiring freeze, there's just sort of natural attrition as people move into other roles within the company even, that helps us deal with that. So we try to do the best we can at, cross training and moving people around and staying close to what people want to do. But no magic bullet on that one either.
Yeah, that's great to hear, because you guys are a big mortgage lender. I mean, $5.5 billion a year in mortgage production, nothing to sneeze at. And, and I, just having seen a bunch of these different cycles, I mean, I remember just 2 falls ago when it was crazy, and, like the better.coms and a lot of these big, they're just throwing money at people. And now these are the companies you see that are, doing the Zoom firings and laying people off. And, organizations like Michigan credit unions never laid anybody off. You have to maybe go through a little bit of pain, right? When that pipeline was just bursting at seams. But
I think, like most of us do, I think we stay focused and have been driven by the purchase part of the business, right? So that's expected to be up, right? And construction is expected to be up. So, that helps moderate things too. By, we all know we need to do it, but when there's that low hanging refi fruit, it's tempting to take a lot of that. But we mostly just kept our members happy and didn't really reach out to bring in new people through the refi business, which, we probably could have done more business in 2020 and 21. But it's also a flatter downside to the curve too.
Yeah, always a cost to those actions. And it just seems like we're in a very, very cyclical business, and lenders that overreact to either going up the roller coaster hill or going down it. Seems like it is rarely a long-term winning strategy, and that the pain on the back end always usurps any benefits or perceived benefits at the time. So
yeah, I guess either strategy I guess could work depending on what your end goal is. I mean, as a kind of in theory a nonprofit, we're trying to serve both just our members and our employees, right? So as opposed to a shareholder or a bottom line investor or whatever. So that helps, for internally to be able to, carry maybe, a little bit deeper staff than might otherwise.
This is the last week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative, and we've got a few minutes left with our co-host this week, Lake Michigan Credit Union's Chief Lending Officer, Eric Burgoon. And Eric, you touched on construction lending, you touched on renovation lending. I actually just got done putting together the agenda for our upcoming TMC member conference in Miami in March. And as you know, that agenda is driven almost exclusively off of a very comprehensive survey that we send our members biannually, leaders like yourselves within our member organizations, and spent a lot of time late last week and early this week just siphoning through the results of, essentially a survey that is just taking key decision-making lender executives, picking their minds on how important certain issues are to them. And it was really fascinating to me to see the differences in that survey from when we did it 6 months ago. And, not surprisingly, some of the themes, automation, another big theme is just alternative products, right? If it's construction lending or renovation lending or non-QM or non-conforming lending or rehab loans, the types of deals that when, refis were just falling off the tree, not a big area of concern for lenders, but the numbers just in terms of percentages of lenders that, were much more focused on those products was up big time, and planning on doing some sessions at conference kind of related to emerging markets like rehab lending and construction lending and non-conforming lending, because we're going into a different climate, right? I mean, it's as a depository with the portfolio, you're able to do those deals that don't fit any investor box, yet make sense for the credit union to put that loan in the shelves. And the way I see it, that's a big advantage to the depositories as we head into 2022.
Yeah, it helps us keep our origination staff, happy and doing a decent amount of volume, because the other thing we didn't touch on too much here, but you were going to see, we've already seen it, right? A lot of competitive rate pressures, those fat margins are all gone, and we're all fighting for fewer deals. That's always gets kind of ugly. So we're working also hard on trying to maintain our pricing discipline, but compete, and we're gonna have to go down to the margin at times on deals to get them. So it's that time of the cycle, I think, beginning.
Yeah. But maybe you don't win every refi on rate, but you can say to that same LO, like, listen, we've got home equity product that are available to your customers, and we've got renovation loans, because I think we're just going to see an explosion of home equity lending, home equity lines of credit. So those homeowners that are locked into those 30-year fixed rates in the low to mid twos that want to maybe just improve their home, as opposed to, as you put it, having to find a new one if they sell it. And also people that want to do formal renovation loans and renovate their home. My guess is that type of lending and those lending buckets, much bigger percentage of the overall pie in 22 than 21 for credit union, right?
Yeah, absolutely.
And
we've all been there before, though. We've seen this a few times, so I think everybody knows what they need to do to compete. But it's nice to have those products for sure. And I agree with you on the home equity side. We're seeing that pick up too. It's it's not part of our mortgage group specifically here, but we do offer those products as well. And that's definitely, we're already seeing that picking up.
Like the renovation side and the rehab lot side, I know, some especially smaller lenders, maybe they'll allocate an originator or two or three that will specialize in that product. You guys open that up to all your sales staff to sell that product, or you kind of have specialists that it gets referred over to?
No, we all do. Yeah. We manage it very much like a construction draw loan. So it's very similar process. So we do training on it, but everybody's able to do it.
Awesome. Just about out of time, Eric, but any other thoughts, comments, predictions on the year ahead of us? You got the first co-host slot of the year, New Year for Last Week in Mortgage Today. So anything to take us home with as we head into?
I don't know, like your Buckeyes finally figured it out. I'm still kind of
that was
still kind of mad from losing the last game of the season, but
oh, I know. And I thought, it didn't look like they really wanted to be there at the beginning, and then end of the game, they wanted to be there. It was an exciting game and good.
Yeah, they're like number 5 receivers could play in the NFL, I think. So
Marvin Harrison's kid, yeah, he caught 5 balls all year and 3 touchdown passes in the Rose Bowl. So
embarrassment of riches, Rich. So.
Excellent. Well, Eric, greatly appreciate all you do for our network and for joining me in the co-host slot for the Last Week in Mortgage Today. And all the best to you and yours as we head into a new year.
Thank you. Same to you and to everybody.
Excellent.
Have a great 2022.
Likewise. And to our attendees, thanks as always for taking the time out with us, working real hard to make this 30 relevant minutes of your week. And we'll continue to do so live every Tuesday at 2 p.m. Eastern. And then, of course, you can find us where I know a lot of you do on YouTube after the fact on our YouTube page or via podcast. So until next Tuesday, have a great rest of the week, everyone. Take care, Eric.